The next economic crisis, how history whispers before IT shouts. 1. Introduction. Every economic crash leaves a breadcrumb trail. Follow it far enough, and you'll find the next one waiting at the end. This time, the problem isn't the banks, the markets, or the taxpayers, it's the government itself. Yes, the same folks who once handed out bailouts like candy are now knee-deep in their own credit card bills. So what does that actually mean? It means history has a habit. Each crisis transfers the pain to whoever saved the last one. Hedge funds fell in 1998, banks cracked in 2008, taxpayers absorbed the blow in 2020, and now the bill has landed squarely in the government's mailbox. Footnote. Every financial crisis passes its burden upward, from private to public hands, until the government itself becomes the debtor of last resort. 2. The hedge fund domino. Back in 1998, a few math geniuses ran long-term capital management, a hedge fund armed with Nobel Prizes and overconfidence. They called their trades risk-free. Spoiler, they weren't. Their zero-risk bets exploded when small price differences, called arbitrage gaps, refused to close. The global financial system nearly keeled over. So what does that actually mean? It means when someone tells you there's a way to make money with no risk, hold on to your wallet. The Federal Reserve had to drag the biggest banks into a rescue mission. The banks absorbed the hit, and the world moved on, quietly setting up the next fall. Footnote. The 1998 collapse of long-term capital management proved that risk-free strategies often carry risks big enough to threaten the entire system. 3. The banker's turn. Fast forward 10 years to 2008. The banks that once saved the hedge funds became the patients on the table. They'd built their fortunes on housing bubbles and bad loans wrapped in shiny names like mortgage-backed securities. When those loans soured, no one trusted the collateral anymore. The repo market, the overnight pawn shop of global finance, froze solid. So what does that actually mean? It means the entire financial system stopped lending each other lunch money because everyone's collateral smelled bad. The government stepped in and, for the first time, made taxpayers the cleanup crew. Footnote. The 2008 crisis exposed the fragility of financial interdependence when the collapse of collateral halted interbank liquidity. 4. The taxpayer bailout. In 2008, the taxpayer didn't see a bill, but they paid one. Inflation rose, jobs vanished, and living costs climbed. Subsidizing financial failure has consequences, they just arrived quietly. The average citizen became the system's buffer. So what does that actually mean? It means too big to fail was really code for you'll pay for it later. The government borrowed and printed to plug the holes, setting the next domino in place. Footnote. Taxpayers indirectly financed the 2008 recovery through inflation, debt accumulation, and declining real wages. 5. The repo rerun in 2020's masked crisis. Then came 2019. The repo market spiked again, yes, the same market that nearly broke in 2008. Liquidity dried up as the government's own borrowing had sucked oxygen out of the room. By early 2020, the stage was already set for a crisis. The global shutdown only gave cover for another round of intervention. So what does that actually mean? It means the meltdown had already begun before the headlines did. When the dust settled, the government had done what every rescuer eventually does, it bailed out itself. Footnote. The 2020 financial instability stemmed from liquidity shortages predating the global shutdown, exposing deep structural debt dependency. 6. The sovereign debt trap. Now the government is the debtor. It taxes too little, spends too much, and borrows the rest, mostly from itself through its central bank. The math no longer works. Imagine earning $100,000 a year, spending $200,000, and moving balances between credit cards to hide the mess. That's fiscal policy in a nutshell. So what does that actually mean? It means the next too big to fail is the state itself. The only entity big enough to bail out the government is the Federal Reserve, which can print the difference. But that fix only inflates away the pain and the purchasing power of everyone else. Footnote: the United States now faces a classic sovereign debt dilemma where monetary expansion replaces taxation as the primary funding tool. 7. Inflation, the hidden tax. Every bailout brings a hangover. When the central bank prints to save the government, the dollar buys less. Prices climb not because of greed but because the money supply balloons. Gold and real assets quietly scream what polite economists whisper: something's wrong. So what does that actually mean? It means inflation is not an accident. It's the side effect of governments trying to pay yesterday's bills with tomorrow's promises. Footnote: inflation functions as an implicit tax that redistributes wealth from savers to debtors through currency dilution. 8. Protecting yourself. There's no magic bullet, but there is strategy. Avoid long-term government bonds and cash piles, they'll melt in real value. Favor real assets, gold, property, equities, maybe even digital stores of value. Fixed-rate debt becomes your friend when inflation eats the lender's lunch. So what does that actually mean? It means stop thinking like a saver and start thinking like an investor. The rules changed, and sitting still is now a losing move. Footnote: personal financial resilience depends on reallocating assets toward inflation-resistant instruments during monetary expansion cycles. 9. Conclusion. The story is simple: every crisis finds a new host. The government's turn has arrived, and the cure will likely be printed, not earned. History may not repeat exactly, but it sure enjoys rhyming. The best defense? Learn the rhythm, and move before the next note drops. So what does that actually mean? It means pay attention. Crises don't appear out of nowhere, they just change addresses. Footnote: recognizing repeating debt transfer patterns allows early adaptation to systemic financial shifts.